Good morning, Tom Tote with Wilshire Advisors. Nice to see everybody again today. Given that Wilshire's going first in this go-round, I'll start with some comments around the broader market, some strategic themes, and then I'll touch on portfolio performance, and then we can happy to take questions, and then we can move forward. If I could have us flip to page 2. These are some strategic themes that I think are important to keep in mind, and they are related to geopolitics in a sense, but much more longer term. So some of the strategic objectives that I think it's fair to say will be true regardless of administration and through time is this idea of being dominant in the artificial intelligence space. And we use the term win, the AI arms race here. I don't think there's really a winning, because it's going to be a consistent, I'll say, process of improvement where folks are, models are getting better, hopscotching each other, and that's just going to be a continual process. I don't think there's really an end to that. The second strategic objective here is rebuilding the industrial base. We've talked quite a bit about onshoring and reducing dependencies on external actors, kind of shoring up, becoming a more resilient economy, we'll call it. This requires a significant amount of investment. And then financial stability. This is something we've talked about quite a bit over the previous quarters, addressing the budget deficits and the current deficit, and ultimately looking to get on a more sustainable path. And how does this link to markets? So those are sort of high-level strategic themes, but how does it play into markets, and how should the committee think about it when it comes to the portfolio? Well, there are risks and trade-offs to those strategic objectives, and we list them there at the bottom. Rising interest rates, and we'll have just a slide to discuss what that might look like. Given the deficit levels, those rising interest rates just increase the dollars that go to debt service, and those dollars cannot be used for other things, and that's something that can be quite challenging. Market drawdowns similarly impact the fiscal picture as governments rely on capital gains taxes. As an example, California is not immune to that, as I know everybody at the dais knows. And then inflation, and this is really where it starts to play into portfolio construction. I mentioned the rebuilding the industrial base is going to take significant investment, and that could be inflationary over time. Now, I want to be clear, there are likely to be some deflationary impacts from artificial intelligence as that is utilized to drive efficiencies in the economy. But the way that I'm thinking about this in sort of a time series is the inflationary impacts are likely to be more front-loaded, and the deflationary impacts from artificial intelligence and efficiencies driven by it are likely to be more medium to longer term. So inflation is a risk that we want to be very cognizant of when it comes to building portfolios. Ms. Taylor, did you have a question?
Just real quick, you said earlier that you weren't really doing geopolitical, so I'm a little confused.
I'll say the short-term geopolitical headlines. So the war in Iran, as an example. This is more, I'll say, grand geopolitics vis-a-vis China in particular. So these strategic objectives are related to that, but not the short-term headlines that we're currently experiencing.
And these are strategic objectives of the United States government?
Correct.
Okay. Really?
I think so. Yeah. Now we can get into minutia, but I think these three are going to be long-lived strategic objectives, and I think that's probably true even rewinding the clock, 2-3 years. With this idea of a K-shaped economy, you might have seen this term in the past, and it's essentially a tale of two different economies, and you can think about them as an economy for those who own assets and an economy for those who don't. And we label them the haves and have-nots here, and kind of give some of the criteria around that. If you own a home or you own a substantial portfolio of stocks, you would be on the haves. If you rent or don't own substantial assets early in your working life, that's the have-nots. And so why the K shape? Well, if you turn to page 8, you kind of see it in the chart. This is a chart of the price of stocks in blue and then consumer confidence in red. And you can see the sharp divergence in 2020 as, again, those who have assets, the price of those assets have continued to march higher. Even at the same time, consumer sentiment, which is a much broader measure, has fallen and remained well below historical longer-term averages since that time period. And so what has driven this? We start to talk about the theme of affordability on page 9. And we start with a picture of wages relative to core CPI. And you can see the whole as wages fell below inflation, which we talked about over the years. That has gotten better. And since as we've moved through time, wages have outpaced core inflation. But that's not the whole picture, and so we say, but that doesn't look so bad there. But if you flip to the last slide I'm going to touch on for the market comments on page 10, when you think about some of the bigger items in a person's life and what those cost, the story is quite a bit different. So what we plot here is wages relative to things like food, which is stripped out of core CPI from the prior page. And that's there in green. You can see wages are still below. The growth in wages is still below the growth in food prices. Home prices, which is generally the largest purchase a person makes, have substantially outpaced wage growth. And then energy, which has been quite volatile, also remains well ahead of the pace of wage growth. And food and energy in particular, which are stripped out of core CPI, those are things that the average consumer has engages with on a weekly basis. You go to the grocery store, food costs more than it did previously. You go to the gas pump, filling up your car costs more than it did previously. And that has a meaningful impact on consumer sentiment. That's the down leg of the K. And that could have spillover effects in terms of economic growth, given that the U.S. is broadly a very consumer-driven economy. If the vast majority of folks are on the lower leg of that K versus benefiting from rising prices in assets, they're likely to retrench and perhaps not spend quite as aggressively as they had before. And this is, I think, an example of where the stock market is somewhat divorced from the underlying economy. And that's become even more exacerbated with the concentration in sort of the mega cap tech stocks, which are having a positive impact on prices, but doesn't necessarily filter through to the vast majority of consumers. And I think that's one of the big explanations for how consumer sentiment has remained stubbornly low, even as stock markets have gone up quite substantially. And even with all of the volatility that we've seen over the last couple of weeks, stock markets are still reasonably close to all-time highs. They're not aggressively lower, although there's been a lot of volatility.
Thank you. Ms. Middleton.
All right. Tom, when we start looking at where investment is taking place, so much of it is being driven by the belief that AI is going to be an incredible change agent and opportunity for every organization that we know. Are there warning signs out there that we are too invested in AI as a change? And do you have any concerns in that area?
Valuations in terms of AI stocks, I'll say I'm generally concerned about that. Overinvested, I would say no. I don't think overinvested is the way I would term it. It's certainly a risk factor. And there's going to be both positives and negatives from AI adoption in the economy. It certainly can drive efficiencies. It can help everybody do their job, I'll say, better. Others might not term it that way. But there's going to be a lot of disruption. And how quickly that disruption happens and how well it's managed are going to be critical success factors. And that's unclear at this point. I'm sure you've read some of the stories about, and I think it was the Anthropic CEO who estimated that AI could replace, I think the number was 40% of entry-level white-collar jobs in the next couple of years. That pace of change is so much faster than anything we've experienced previously. How you manage through that change is going to be, is going to be very telling. And so that's a big risk. I don't want to underplay that. But what we see on the other side is likely to be some pretty cool things. I mean, not to undersell it. I think I'm a big believer in technology. I think generally that progress leads to higher standards of living, but there's certainly going to be bumps in the road, and those need to be managed.
I think one of the scary things that is out there is the markets have been incredibly resilient. But we have, you used the word uncertainty. I lost track of how many times during the course of the last 15, 20 minutes. And it's what everybody's saying over and over again as we approach so many different issues. And leaves all of us wondering, at what point does something catch up to us?
Right. And I think the key for managing the portfolio through a period of time like that is consistency through time. There will be a period of time where it catches up, the market draws down. It will be a scary time as investors, remaining focused on the strategic plan, continuing to invest, looking for opportunities. When you get to the other side of that period, that will be a successful investment program. So something to keep in mind.
Thank you.
Mm-hmm.
Thank you. Those are all the questions. Ms. Walker.
Oh, sorry. Okay. Hi, Tom. So as we're talking about AI, and I, like you, believe in, it's coming, it's going to be here, and we have to figure it out. But as far as our investments, how much of it gets, how much do our changing workforce play into the investments we make? Because, we'll have to train people differently. If things are to be believed, there will be less workers. What are we going to do with those folks? We don't have a society at least in America, that says, hey, we're going to take care of everybody. We don't have that society. And I think that would have an impact on where we invest and how we invest, and, because of our lives. I mean, even today, I was talking to a lady in the park when I took my grandsons, and the notion that, like, her son, he's back home, he's in his 30s, he's embarrassed, he cannot afford a home, which has typically been where we get our wealth, right, our familial wealth. And, and I see it with my own kids, right? And so how do we balance that out with investment? Because we're here to make money, but what good does it do us to make money if our families, because most of the people that invest in this fund are, working class people. And
Sure.
So if our families cannot thrive, or have even the smallest part of what we have, what is our responsibility then as the fund?
Ms. Walker, you're asking the really difficult public policy questions, and so I'll try to link that back to what is in the portfolio or could be in the portfolio that starts to address it. But I don't want to hold out the perf as the solution to those,
Right.
because that's certainly not my role. So where are you getting exposure to that? So things like in the real assets portfolio, building new infrastructure to improve, the community, the lives of communities. Potentially multifamily housing could start moving down the path. Affordable housing. We talked at, I believe it was the July offsite last year about affordable housing as an opportunity. Again, that's something that could address the topics that you brought up. And the portfolio really across the board in both public equity and private equity has exposure to the AI innovators, which are likely to be the beneficiaries of this change. And so that I think in terms of how to manage the portfolio through a period of uncertainty, it comes back to first principles, which you've heard me say in the past, and that is diversification, looking for opportunities kind of across capital markets so that you're connected to, I'll say, the big winners in a changing economy.
Okay.
Miss Taylor.
Thank you, Mr. Palkey. So Ms. Walker brought up a very prescient item. We're already dealing with this. My son lives at home because it's just cheaper. He makes a lot of money. I mean, a decent amount of money for working in the public sector. And it's easier for both of us to pool our incomes to not have to pay each of us $3,000 a month for rent, right? And then talk about owning a house, then that is even something else entirely. And I think AI, while we're hearing a lot of stuff from the owners and the movers and shakers of AI, I think some of it could possibly be a lot of promotion right now. But the last thing we need is putting people out of work, because this government is not set up to even consider universal income or anything like that to replace, or affordable housing. There's just no, it's so intrinsic, our housing market's so intrinsic with the stock market and making money. That's why it's become so unaffordable. I think my main concern is what you kept saying through your presentation is the uncertainty that we're in right now. And we've had some years of really great growth that have helped CalPERS recover. What I fear is this uncertainty under this current regime that we're under, with things going off the rails all over the place, right? We've got wars, we've got all kinds of things, and I'm not even going to go into that, but that kind of uncertainty eventually lends itself to the market having a downturn, right? We can talk about people put out losing their jobs or too afraid to be at their jobs because of DHS. We can talk about the Iran war, the lack of oil, which also will cause a supply chain issue. So how do you see, if this were to result in a downturn, do you see it as a cataclysmic downturn as big as something like 2008? Or is it something that, as someone else said, that we seem to have kind of a divorced reality between the markets and the reality? Is that going to be the case, or is it going to be a softer downturn? How are you seeing this?
I would probably err on the side of a softer downturn or a shallower downturn. The 2008 analogy, I don't see that. The cascading linkages that befell the whole financial system. I don't see that even in a slowdown, and so I think it would be more of a I don't want to sugarcoat this, a garden variety sort of economic slowdown or recession, which you have some,
By sector,
restructuring.
you're thinking more like, or all around?
Usually a slowdown is driven, it will have some sector specific kind of impact, but generally leads to a kind of a broader based slowdown in terms of growth. We talked a little bit about questions around credit, what that looks like moving forward, and are there some linkages there that are going to be exposed? That's certainly a risk, and I know the team is very focused on that. You heard Masha talk about that. And the analysis that her team is doing around that. But it's a risk, and we want to be attuned to it. And I think what it, again, comes back to is we don't want to be concentrated in one area, and we want to diversify across capital markets. Some parts are going to do better than others. Some sectors are going to do better than others. And being exposed to that is really the way to manage through the volatility. So that's what I would say, keep your eye on the prize, so to speak. So to answer your question, Ms. Taylor, I think if we were to see a slowdown, it's likely to be shallower, more garden variety, and not something cataclysmic like 2008. I don't see that on the horizon.
I appreciate that. One of the issues with the AI sector is that there's a lot of money needed, much more money than Silicon Valley or any IT stuff has ever needed before. And I just curious, that's like one of the largest sectors of profit in our markets right now, right? It's like the top 7 companies. Mm-hmm. So what happens if that is truly a bubble, which is what I'm reading all over the place, there's too much money and not enough performance to show that that's actually working, mm-hmm. right? That AI is actually working. So that's also another factor, let alone the geopolitical factors.
Right. And that plays to valuation, which does go into our forward-looking assumptions, which we've talked about in the past. I certainly think that's a risk. That concentration in public equity markets, in particular, is something we've highlighted before. And moving from investment, which is substantial, and there's actually been, I don't want to get too in the weeds here, but there's been a bit of a shift from the funding of that investment from company free cash flow to debt issuance, and it's still they're making a lot of money.
It's still a problem, yeah.
But it can be a bigger problem if you transition too much into credit, and if that goes, that can have those linkage effects I alluded to earlier. At this point does not appear to be an issue, but something to be attuned to, moving forward as another risk. In contrast to the internet bubble in the late 90s, many of these companies that have performed so well are also making a lot of money. It's not the pure speculation that we saw earlier, but there are some big privately held companies that have not turned a profit yet and continue to invest and invest and invest, and those are more speculative. I don't think you can get around that. The market that they're addressing is enormous, so it could pay off, but the period, the time horizon for that is uncertain.
Thank you very much.
I keep using that word, and
I know, but that's where we're at. I appreciate it.
Thank you, Ms. Walker.
Okay, sorry. So, Stephen, maybe this is for you and not Tom, but it could be for both of you. So don't feel like one or the other has to answer. But, as we talk about uncertainty, that's the one thing that we can count on. It's always going to be uncertain. There's going to be bubbles. There's going to be ups. There's going to be downs. There's going to be all of these things. And so in my world, how I dealt with it is, do a lot of scenario planning, right? So regardless of what, as best you can, you figure out like what's coming or not coming. And as best you can, you have something ready so that, you can respond. I think at this moment, it makes a lot of sense that we have moved to TPA, because I think it's going to make our ability to respond a lot different, right? So I don't know. Are we doing that? Make me feel better. Make me feel better and say, absolutely, you don't have to tell me exactly what we're doing in this form, but make me feel better.
I don't know if this will make you feel better or not, but it's actually very hard to scenario plan. What I think is probably more important is to be thinking about possible scenarios and what happens to the portfolio in those scenarios. And it may be that some are unacceptably painful, and we can do something about that in terms of changing the portfolio. But the idea that we can predict a scenario and pre-position the portfolio for that is challenging, because by the time a scenario becomes, let's say, obvious, the market's priced it. So the idea of having do this, like break glass, do this, if event X happens, it's actually very hard for a portfolio our size to pre-position for that.
Very good.
Okay. I'm not thinking in terms of a, break, this happens, break class, do this, right? Because that is really impractical, right? But it is, and I guess maybe you're saying the same thing. You look at, as much as you can, and nobody has a magic ball or a crystal ball, but as much as you can, like, what are the odds of this coming or that coming or whatever? And how can we position ourselves in the interim, right? So that it is easy to pivot, for lack of a better word. And I'm not doing this in money terms, but I hope I'm coming across to you.
Yeah, no, we'll talk about this when Lauren comes up as well, and talk
Okay.
about some of the scenario maps or heat maps.
Okay.
And the key is a word that Tom mentioned before. It's diversification. It's about having things in the portfolio that do relatively well given different scenarios. So we will have things in the portfolio that typically do well when growth is strong and inflation is low.
Right.
The challenge is more about having things in the portfolio that do well when growth is poor and inflation is high. And of course, that is a potential situation. Now, if the crisis in Iran extends for a long period of time, so that's a stagflationary environment. So the things that normally hit portfolios like ours, or for almost any pension fund, will be recessions and stagflation. But we can have some things that do mitigate some of the risks. So there are some equity exposures that have done very well during this period. And you could think of the oil companies, maybe defense, and so on. But it's about having that diversified portfolio. But we'll talk about that when Lauren comes up.
Okay, you're making me feel a little better.
And Ms. Walker, maybe I can provide a specific example that hopefully will make you feel better. The liquidity planning that you've heard the team talk about, that provides some of those, the ability to react and to make sure that you have liquidity when you need it, which could be redeployed in an opportunistic fashion to take advantage of dislocations. And that's been a substantial improvement over the years, the last number of years, to improve both the look through into the portfolio's liquidity position and then ways to access it through time. So the ability to pull those levers is something the team has improved meaningfully.
I think that's absolutely true. The other side of that, of course, is that having adequate liquidity means you don't have to sell things when you don't want to. So both of those things can be value additive.
Yeah.
Anybody else? Okay, those are all.
Very
That's
good.
all I have on my